What if the real danger in high-yield investing isn't the investment itself, but the illusion it creates? The steady payouts feel like progress, like you've cracked the code to effortless income, but what if that cash flow is quietly masking a shrinking foundation? The most dangerous portfolios don't collapse overnight. They slowly convince you that everything is working until the moment you realize your wealth was never truly growing. The good news is, you can undo that illusion today. In this video, you're about to discover 5 ETFs that break every rule most investors think is unbreakable. These aren't just high-yield funds throwing off big dividends. They're strategically engineered to grow your wealth at the same time. I'll also walk you and Bobby through the real numbers behind 2 standout performers, showing how a single $20,000 investment could grow to more than $300,000 while generating over $4,000 in monthly income. That's not hype. That's the power of structure, strategy, and compounding working together. These ETFs are not flukes. They are built differently and specifically designed to turn market volatility into a consistent, income-producing machine that can accelerate your path to financial freedom. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. First, let's imagine this. You walk into an orchard you just bought. Every month, you pick baskets of fruit, more than you expected. It feels incredible. The harvest is consistent, almost addictive. You start thinking, this was a genius decision. But then something subtle begins to happen. The trees aren't growing. In fact, they're getting smaller. At first, it's barely noticeable. A branch here, a leaf there. But over time, the harvest you're so excited about is not coming from new growth. It's coming from the trees themselves being cut back, piece by piece. That's what Nav erosion looks like. In simple terms, net asset value, also known as NAV, is the actual value of everything inside an ETF, its underlying investments. When that number declines over time, it means the fund itself is shrinking. Here's where it gets uncomfortable. Some high-yield ETFs advertise massive payouts, 18%, 25%, even 30%. That sounds like your money is working overtime, but in many cases, those dividends aren't purely profits. A portion can be a return of capital, which is just your original investment being handed back to you. It feels like income. Your account is receiving cash. Your brain registers it as progress. That little dopamine hit reinforces the belief that you're winning. But behind the scenes, your base is quietly eroding. It's like withdrawing $1,000 from your savings account every month and calling it income. The balance looks fine at first, but over time, the math catches up. This is why some investors feel confused. They see consistent payouts, yet their portfolio value trends downward. The contradiction creates doubt. Am I doing something wrong? No, you're just seeing the full picture now. And this is where smarter investing begins, because not all income strategies are built the same. Some ETFs are designed to generate real yield, income produced from dividends, interest, or sustainable option strategies, while actively maintaining or even growing their NAV over time. That's the orchard that keeps expanding. The trees grow stronger while still producing fruit. Now imagine the shift in mindset. Instead of chasing the highest yield, you start asking a better question. Is this income being generated or returned? That one question can change everything, because true wealth isn't just about how much cash hits your account today. It's about whether your foundation is getting stronger while it happens. When income and growth work together, something powerful happens. Your portfolio doesn't just pay you, it builds you. And over time, that's the difference between temporary income and lasting financial freedom. Coming up at number 1 is the Yield Max Semiconductor Portfolio Option Income ETF, ticker symbol CHPY. What if you could turn the constant noise of the tech market into a steady stream of income without needing to predict a single winner? Picture this. Every time the market reacts to a chip shortage, an AI breakthrough, or a surprise earnings report, instead of feeling anxious, you get paid. While most investors watch charts and brace for impact, you're positioned to benefit from the very movement they fear. That's the core idea behind CHPY. Semiconductors sit at the heart of everything. artificial intelligence, electric vehicles, smartphones, cloud computing. Companies like NVIDIA, AMD, and Taiwan's Semiconductor Manufacturing Company don't just participate in innovation, they power it. And where there's innovation, there's volatility. Prices move, headlines hit, markets react. Most people see that as a risk. This strategy sees it as an opportunity. Instead of relying only on stock price growth, CHPY uses a covered call approach, essentially collecting premiums from investors willing to bet on future price movements. Think of it like owning a busy toll bridge during rush hour. You're not guessing where every driver is going, you're simply collecting a fee every time someone passes through. And in tech, traffic never slows down. That's where the shift happens psychologically. You're no longer hoping the market behaves, you're positioned to benefit because it doesn't. And that changes everything. Because now, volatility isn't your enemy, it's your income source. The ups, the downs, the uncertainty, they all become part of a system designed to generate consistent cash flow. Behind the scenes, the strategy stays disciplined. It's not chasing hype or reacting emotionally to daily news cycles. It follows a structured, repeatable process built for one purpose: turning market movement into monthly income. And when you combine that with a yield around 21% and modest long-term growth, the picture becomes powerful. This isn't about hitting a home run on one stock. It's about building a system that pays you over and over again as the world continues to move forward. This ETF sounds fantastic, but there are still better options coming up, and I will walk you and Bobby through the real numbers behind two standout performers, showing how a single $20,000 investment could grow to more than $300,000 while generating over $4,000 in monthly income. The next unique ETF on our list is the NEOS Bitcoin High Income ETF, ticker symbol BTCI. Bitcoin has always been defined by extremes: explosive rallies followed by sharp declines, headlines swinging from excitement to panic in a matter of days. For many, it feels impossible to control, but BTCI doesn't try to control it. Instead, it converts that constant movement into opportunity by using options on Bitcoin futures to collect premiums from traders betting on price direction, turning that volatility into monthly income. It's like owning a power grid in the middle of a lightning storm, where every strike that unsettles others becomes a source of energy for you. The more intense the storm, the more income potential is created. This shifts your mindset completely, because you're no longer reacting emotionally to Bitcoin swings, you're positioned to benefit from them. What makes this even more compelling is that BTCI hasn't just delivered income, it has also shown strong underlying growth, with NAV appreciation exceeding 26% alongside a yield above 22%, creating a powerful combination of cash flow and portfolio expansion. Instead of choosing between growth and income, this approach aims to capture both. And the reality is, Bitcoin's volatility isn't going away anytime soon. It remains driven by innovation, global adoption, and constant speculation, ensuring that price swings will continue. For BTCI, that ongoing movement is not a risk to avoid, but an engine that keeps generating income. Over time, the real advantage becomes clear. You stop fearing the chaos and start recognizing it for what it truly is, an opportunity to get paid consistently, month after month. Securing the third position on our list is the NEOS NASDAQ 100 High Income ETF, ticker symbol QQQI. This exceptional ETF is the kind of investment that earns its place by doing more than just sitting in your portfolio. It works consistently in the background, generating income while you focus on living your life. Instead of trading time for money, this creates a system where your capital takes on that role, producing monthly cash flow without interruption. With a distribution rate around 15%, it feels like a second income stream, steady, reliable, and always showing up. But what makes it truly compelling is that it doesn't stop there. Since inception, it has delivered roughly 27% total return, combining real growth with real income instead of sacrificing one for the other. That balance is rare, and once you see it, it changes your expectations. The strength comes from its foundation in the NASDAQ 100, which includes dominant companies like Apple, Microsoft, NVIDIA, Amazon, and Meta platforms, businesses that continue to expand and shape the global economy. On top of that, the fund runs a covered call strategy, collecting premiums from market movement, and turning that activity into consistent monthly income. It's like owning a premium asset in a fast-growing city that increases in value over time while also producing rental income every single month, allowing you to benefit from both appreciation and cash flow simultaneously. This is where the mindset shifts, because you're no longer choosing between growth and income, but building a system where both work together, creating a portfolio that not only grows quietly in the background, but also pays you consistently along the way. Now, let's check out the projections. First, let me break down a simple formula that will be used for the calculations. It is called the future value formula. At its core, it answers one simple but powerful question. If I invest money today, what will it be worth in the future? The formula consists of 4 key components, each playing a specific role in determining how fast your investment grows. The first part is FV, which stands for future value. This is the end result, the number every investor cares about. It represents how much your investment will grow to after compounding has done its work over a set period of time. Next is PV, or present value. This is your starting point, the initial amount of money you invest. For example, our PV for this projection is $20,000. Then comes R, the rate of return. This is expressed as a decimal, so a 10% annual return becomes 0.10. This number is critical because it determines how aggressively your money grows each year. Next is N, which represents time, measured in years. For this illustration, our N is the 10, 20, and 30-year milestone. Using this formula, let's dive into the numbers of QQQI. This projection is based on Bobby's one-time lump sum investment of $20,000. At year 10, Bobby's portfolio will grow to $51,874, generating $7,579 annually. That's about $632 every month. Yes, it may not retire him yet, but make no mistake, the machine is built, the engine is running, and compounding is just getting warmed up. What looks modest on the surface is actually something extraordinary happening beneath it. By year 20, that momentum becomes impossible to ignore. Bobby's portfolio surges to $134,546, yielding an annual dividend income of $19,657 or $1,638 per month. The same $20,000 he invested years ago has multiplied nearly 7-fold, not because Bobby worked harder, not because he got lucky, but because he simply refused to quit on time. That's the silent secret compounding never advertises. Its greatest gains aren't earned through action, they're earned through patience. Next is the 30-year mark. Bobby's portfolio explodes to $348,980, and now the money stops just growing and starts performing. His portfolio will start generating $50,987 every year, which amounts to $4,249 each month, without a single meeting attended or an alarm clock answered. Remember, this is all because of one bold investment decision and 3 decades of discipline. And the result? A monthly paycheck that most people spend their entire careers working toward, built not by working more, but by taking a bold decision and staying committed. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Coming in at the 4th spot is the TAP Alpha SPY Growth and Daily Income ETF, ticker symbol TSPY. What if you could take the entire strength of the US stock market and turn it into a system that pays you daily? That's the idea behind this exceptional ETF, and it challenges one of the biggest fears income investors have. If the yield is high, the NAV must be eroding. But here's where this strategy is different. Imagine owning a massive shopping mall in the busiest city in the world. The property itself, the land, the structure, the location, keeps increasing in value over time. That's your exposure to the S&P 500, the foundation of TSPY, which gives you access to the largest, most dominant companies in the US economy. But this is the key to this strategy. Instead of just waiting for the property to appreciate, you're renting out space every single day. Not monthly, not occasionally, daily. Every day businesses pay you for access to that space. Some days more, some days less, but the cash flow never stops. That's exactly how TSPY works. The fund writes 0 DTE, also known as zero-day to expiration call options, every single trading day, capturing rapid time decay and turning it into consistent income. This daily reset is powerful because it reduces prolonged market exposure and allows the strategy to continuously adapt to changing conditions. Now let's talk about what really matters: sustainability. TSPY isn't built to drain itself to pay you. It's built on two engines working together. First, core growth from the S&P 500, which historically compounds over time. Second, daily option premiums, which are generated from real market activity, not just artificial payouts. This combination is key, because NAV erosion typically happens when a fund overdistributes without a strong underlying asset base. But TSPY keeps that base intact by staying anchored to one of the world's most resilient and diversified indexes, while using short-duration options that reset daily rather than locking in long-term risk. The result? A distribution rate around 14 to 15%, with a structure designed to participate in market growth while generating income on top of it. And psychologically, this is where everything changes. You're no longer choosing between safety and income. You're no longer sacrificing growth just to get paid. Instead, you're building a system where your portfolio has two jobs: grow with the market and pay you along the way. Because the real breakthrough isn't just earning income, it's earning income from a strategy that still has something left to grow. Next, let's dive into the numbers of TSPY. At the 10-year mark, Bobby's initial $20,000 grows to $51,874, generating about $7,444 in annual income. Obviously, this may not sound life-changing yet, but that's because compounding needs time to demonstrate its magic. Check this out. At the 20-year mark, Bobby's portfolio stands at $134,546, now generating $19,307 per year or $1,609 every single month. The original $20,000 has grown nearly sevenfold thanks to the breathtaking power of uninterrupted compounding doing exactly what it was designed to do. This is the chapter where most people finally realize they should have started sooner. Then comes year 30, and the full weight of Bobby's patience lands all at once. His portfolio now stands at a commanding $348,980, and the income it generates is nothing short of remarkable: $50,078 every single year or $4,173 every month. No resume required, no performance review, just a portfolio that has matured into a fully functioning income machine. This is what TSPY makes possible: one $20,000 investment, compounding with purpose, evolving from a promising seed into an unstoppable income stream. Bobby didn't find a shortcut, he found something better, a starting line, and he was bold enough to cross it. And now, in the fifth spot, is the NEOS Russell 2000 High Income ETF, ticker symbol IWMI. What if the most overlooked part of the market could become one of your most powerful income engines? That's the opportunity behind IWMI, and it starts with a part of the market many investors ignore: small-cap stocks. While most attention is locked on mega-cap giants, the real growth stories often unfold quietly in smaller companies, where innovation is faster, expansion is earlier, and volatility is significantly higher. And that volatility? That's where the income begins. IWMI is built on the Russell 2000, which represents 2,000 small-cap US companies across a wide range of industries. These businesses are more agile, more reactive, and often more sensitive to economic shifts, which means their prices tend to move more frequently and more aggressively than large-cap stocks. Most investors see that as a risk. This strategy sees it as fuel. Instead of simply holding these companies and hoping for long-term appreciation, IWMI actively monetizes that constant movement through a covered call strategy, collecting premiums from market participants and converting that activity into consistent monthly income. Every swing in price, every surge or pullback, becomes an opportunity to generate cash flow rather than a reason to panic. It's like owning a network of local businesses in a rapidly growing town, where activity is constant, demand is always shifting, and every transaction creates an opportunity to earn. The environment may feel less predictable, but the level of activity creates more chances to generate income. What makes IWMI especially compelling is that it doesn't abandon growth to achieve this income. Small-cap stocks historically offer higher long-term growth potential compared to their large-cap counterparts, and IWMI keeps that exposure intact while layering income on top through its option strategy. This is where the balance matters, because NAV erosion becomes a concern when income is paid without a strong underlying engine. But IWMI is powered by two forces working together: the growth potential of small-cap companies and the consistent premium generation from options. That combination helps support distributions without relying on simply returning your own capital. The result is a high-yield structure designed to produce meaningful monthly income while still participating in the upside of an often underappreciated segment of the market. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.